to you on these 40 units with Washington Court and McGregor Apartments. Jay, Anthony, Jason, thanks for being here, and all the attendees, we appreciate you. Jay, what do you think of this deal? It's pretty exciting, right?
It is. Yeah, there's a lot of opportunity with both of these deals. So I think we're going to cover a lot of content on this webinar today. So excited for all of you to join us this evening. And with that being said, I think we'll dive right into it.
Sure. Well, before we get started, a little bit of a disclaimer. Jay, you want to put that up real quick? Just abiding by the good old SEC here, but the strategies mentioned in this presentation may not be appropriate for everybody. Other options not mentioned may be more suitable for your specific circumstances, and you need to consult your personal accountants, tax advisor, and/or attorneys to discuss your specific situation. Now, past performance is never guaranteed for future results. We all know that. Real estate purchases are always subject to investment risks, including the possible loss of amounts invested, right? While every effort's made to maintain accurate and current information, which we always do, the possibility of errors and updates always exists. So now that we got that out of the way, Jay, let's tell them a little bit about the overview here. So if you want to hit the executive summary, potential investors, the exciting piece here, I want to tell you a little bit about the story about this investment. This value add opportunity located here in Cincinnati, obviously we mentioned to you before, perfect location, 5 minutes from University of Cincinnati and Xavier University as well, major hospital networks, and really, really close to downtown. So we're seeing a lot of demand for housing in the area, and we're very excited to implement our value add business plan in both of these properties. So a little bit about the story. Washington Court McGregor Apartments, it's being sold by a motivated seller. You know, what we're doing is coming in and seeing an opportunity where somebody's experienced poor property management. One of the owners is traveling abroad. They're pretty much checked out, exiting the property. The other is really pivoted to more of the residential assisted living here within the Cincinnati Metro. So a lot of projects revolving around that and not as much residential. So where we see the upside potential is really to transition this asset to higher market rent, really based on our business plan, which is renovation and stabilization of the units. We see somewhere right around rents being about 7 to 13% below market. And what we're going to do is obviously go in and do what we do best, which is implement a vertical integration, Prosper Communities, or Prosper Communities Property Management, Prosper Construction, which is going to handle all the renovations, and which we do in all of our units here in the Cincinnati Metro. Now, within this deal, a little bit about the details about what the capital raise is. We're only seeking about $800,000 in equity, right? That is a 70-30 split. So investors will own a 70% equity position, and the managing partner, which is Prosper, will retain 30% equity interest. So upon the capital event, which is the refi or sales, you know, the investors would receive 100% of their capital investment first from the proceeds from the sale, or refinance would be split pro rata. So we're projecting cash out refi in year 3, targeting about a 40 to 50% return of capital for investors. So let me talk a little bit about, Jay, the phase 1 and phase 2 approach that we've done on some of our other properties. Phase 1 really presents the opportunity to reposition the property by bringing in, as I mentioned before, the property management, doing rent bumps where we can. The 2 beds, they offer around 100 to 200 rent bumps per unit upon lease renewal. So we see some nice low-hanging fruit there to increase our net operating income. And as mentioned before, we do see a 7 to 13% rent below market there. Most of the time, what we see is upon acquisition, the stabilization period, you do have obviously to deal with the poor decisions the previous owner has made, right? So you're dealing with tenants that are typically problematic. Sometimes they like to test the new property management. Nothing that DJ and his team can't handle on a daily basis, right? So something that we're really comfortable in doing, and we've done on many of our properties before. So phase 2, which would really consist of strategic renovation to market rate these units, really is to achieve one goal, right? How do we maximize the NOI, the net operating income on this property, and really turn these units, implement the business plan to really prepare for what we're all here for, and that is, disposition of the property after we get through the hold period. So a lot of the CapEx projects that will be included, in parallel with the unit renovations, will be new painting, the exterior, parking lot, asphalt. We do resealing and striping, landscaping, and really what we've done in many of the other properties, Jay, before, right? Which is really that rebranding, right? So we're buying an asset, it's been poorly managed, lot of, deferred maintenance, but we want to go in there, we want to refresh and renew the property, and we really want to do what is best, obviously, for the residents and give them a great place to live, right? Have them feel comfortable where they're coming. And, that really in turn does one thing for us as investors, and that really secures the asset as a great investment and gives us the opportunity to really maximize the return the best we can. So Jay, you want to talk a little bit about this slide with me? 2.8 million is the purchase price, which is a phenomenal deal in this market, per unit price. Year build's about 60, 68, and this is a C-class building. So something that's really in our wheelhouse, right? In our buy box, buying these 60 vintage buildings, 70 vintage buildings, and going in and implementing our value add plan. We do plan to hold the property 6 years. And Jay, as we've talked before, we are projecting an IRR of 15 with a 16% average AR. So cash on cash is right around 7.6% for the 6-year average, and the equity multiple about 1.96. We are paying a pref of 5% on this, and the split is obviously 70-30, as mentioned before, until 15% IRR, and then the hurdle of 60-40 thereafter. So projected returns without refi we have on here. We always like to give you all the options as 4 years hold period with an IRR of 15%, still hitting an ARR of 18%, with a cash on cash a bit lower at 5% at the 4-year average, which then would take the equity multiple without that refi down to about 1.74.
Yeah, no, thank you, Andy. And the reason we wanted to list down both the options with and without refi is because you would see that there are several deals that pencil out only with a refi. And what happens is we've already seen in the last 2 years, the interest rates have gone up like crazy and refis have not been possible. And those deals are falling apart, which is why we always underwrite deals with and without refi projections to make sure that the deal actually pencils even without a refi. Of course, it looks sweeter with the refi. With the rates coming down now, they're already coming down. They've gone down by about 50 bips or basis points since July. And Feds have made the announcement that we'll probably see a first rate cut in September. The deal will look even better. And the refi projections or possibility of a refi are going to be even higher as these interest rates begin to come back down. But this just gives you an idea that even if we don't do a refi, our return projections are still looking pretty strong. Double-digit returns in today's market with the interest rates where they are at is incredibly difficult to achieve, which is also perhaps why you're probably seeing not a lot of deal flow out there. So that's why we wanted to lay this all out in on this slide here.
Very well put.
Cool. And we'll talk a little bit about the property itself. So these are the actual pictures of the property as it stands today. And Andy, myself, DJ, we walked all of the units. And honestly, we were actually pleasantly surprised because if you look at these buildings, the curb appeal is not the best. So going in, we were like, oh, we don't know what we are going to find. With value add deals, you always find surprises. But we were actually pleasantly surprised when we walked all of the units. The units themselves were in really good shape. Both the buildings are brick buildings, so brick and concrete construction. These buildings are basically built like a tank, so structurally really sound, because you don't want to deal with structural issues, because that really burns a hole in your pocket without really adding a lot of value to the property and rent growth, right? So structurally, the properties were sound. The neighborhood that both of these properties are in, Andy alluded to initially as well, one of the properties is very close to Xavier University, and one of the properties is close to UC. So there is a lot of value add potential. And when we talk about value add, we look at three aspects. This is something that we've also covered on some of our previous webinars. The first value add is location, right? Is the location improving over time? And this is in the area called Midtown, which means it's going to be closer to these schools. This is closer to downtown. So it's a great asset for or for renters who work in surrounding areas and in downtown, but also for students. So we have multiple options. So in that terms, location is great and constantly improving. The second aspect of it is property management. Can we do better with operations than the current management that is in place? I have no doubt in my mind that we can do better on management, because the person who manages this asset today, we have worked with them before. And the thing is, with third-party management, no matter what you do, you'll never find the efficiency with third-party management that you can implement in-house, because our own skin is in the game. We are equity partners on the deal. So we take extra caution and extra effort in finding vendors who can give us the best deal in terms of construction and repairs and maintenance and stuff like that, which you just can't expect with third-party managers, because they want to make their lives easier by just finding the first person who can address the issue, not necessarily address the issue for the best possible cost, right? And then the third option is, of course, it's a dated asset, so we can add value through renovations. So when we are able to check all of these three boxes, we know that we can actually increase the property value and we can increase the rents and NOI. So these are some of the interior pictures. This is the Washington Court Apartments. This is 18 units, all 2 bedrooms, built in 1968. This is the asset that is closer to Xavier University. What we like about this is a fantastic unit mix as well. All 2 bedrooms tends to get more sticky tenants, because if you have smaller units, studio apartments, people tend to move every year, and then you're stuck turning the units and renovating the units basically each year. If we are looking at the actual rents, these are the actual in-place rents. We are looking at about $1.14 per square foot. Again, this is roughly about across the portfolio about 12% lower than market rents. If we move to the next slide, this is a similar story in McGregor. This is a 1960 product. Occupancy currently is at 81.8%. And looking at our rent comps here, we are at 1.52. For being this close to University of Cincinnati, we are again fairly below market. And the units in this property are actually pretty much most of them are semi-renovated. So LVT flooring, newer cabinets, newer white appliances that are in great shape that we can leverage. So we don't have to put in that much of CapEx in basically just renovating these units to the fullest standards. So we were really pleasantly surprised when we walked this property, because it was in really good shape. So all we'll have to do is exterior renovations. Some of the pictures that we have seen for the same asset from about 2.5 years ago, when another ownership group owned the property, completely different. When we walked the property, the landscaping was overgrown. So we already know what the potential is. And because the current ownership has renovated some of the units, we already know what rents we can achieve on some of these apartments. So we don't even really have to look at some of our rent comps. We already are achieving those rents, and those are the comps that we are using. Of course, we are using rent comps from our neighboring properties as well to be extra cautious, but we already know what's proven and what we can achieve. So this is a typical renovation. These are not just some sample pictures. These are true pictures from some of the renovations that we have done. So obviously we do 3 different grades of renovation. The first grade, bottom of the barrel, is a basic turn. A basic turn would be just throw on some fresh coat of paint on the walls, maybe change some light fixtures, some door hardware, clean up the unit, and that's basically it. So some of the units that are in fantastic shape, we can get away with just basic turns. Now, some of the units that need more work, they would have to be brought at least to the mid-grade standard, as we call it. which means new flooring, rip out all the nasty carpet, put down LVT floors, paint the unit, light fixtures. On this asset, we potentially may not go with a premium turn, which is granite countertop, tile showers. We might do a few units to that quality, see if you're getting a true premium on that type of renovation, and decide to do more units in premium. So based on our CapEx schedule, we have decided, okay, we'll do few that would be basic turns, few that would be mid-grade, and few that would be premium. Our premium renovations can be seen on these images here. So essentially, that gives us flexibility to see what type of ROI we are getting on the money that we are putting in. And based on that, we'll make CapEx decisions. But we have factored in a lot of reserve in our CapEx budget, which we will be covering on some of our follow-up slides. So I spoke a little bit about rent comps. So here are the actual rent comps. So some of the adjoining properties, they are getting about 1.67. We are targeting a 1.74. That is something that we are already getting for the renovated apartments. And these adjoining properties are actually not even renovated. They have black appliances. So half of the apartment basically has carpets in bedrooms, LVT in the kitchens and living rooms. So essentially, it's not even an apples to apples comparison. We are comparing with a product that's going to be one level below after we are done with renovations. So 1.74 is what we are targeting for one bedrooms, and about 1.65 is what we are targeting for a renovated unit for our two bedrooms. And if we look at our rent comps, again, it's going to be in between 1.30, 1.44 to 1.74. Now, 1.71 is actually the closest rent comp that we could find for a renovated unit. So that's the one we are taking, and we are pricing ours below that. So at 1,200. Again, this is the rent that we are already getting. So the two of the units that are renovated to that standard, we are already achieving those rents. So we are just projecting, okay, what we are already getting is what we are projecting 1 year down the road. So we are not even really baking in that rent bump or market rent bump into that. On Washington, which is our all two bedroom, 18 unit property closer to Xavier, our pro forma is at 1.29, while the average of rent comps is 1.38. So we are actually projecting a much lower than all of our average rent comps. Again, 1125, which is our pro forma rent, is something that we are already achieving in place on a couple of the units that have been renovated at this property in its current condition. So keep in mind, we are doing a lot of exterior renovations. So as you can see from the pictures, the assets don't really look great from the outside. They look older, standard red brick buildings, stucco. So once the brick is stained, the stucco is painted, we'll be painting all the common areas. Once you make the asset look a lot more modern, and then you have a nicer unit on the inside as well, you have an opportunity to push these rents even further. But for pro forma purposes, we are actually keeping the rents at basically the same price that they are renting right now for renovated units. So I'm just trying to say that we are trying to be as conservative as possible for multiple reasons. We all know that rents are not growing as fast as they were just about 2 years ago. Rent growth has somewhat flatlined. Thankfully, we are still seeing positive rent growth in Cincinnati market, but as conservative as we can be on the rent growth is going to be great. And if the deal still pencils out in terms of NOI with our in-place rents, then we know it's going to pencil out after renovations if we are able to push the rents even further. So that's kind of the key here. This page just basically shows a summary of our pro forma rents across both of the assets. So this shows essentially the key thing to see here is we are just projecting about 12% rent increase. And that's after renovations. So typically, most of the underwriting that I've seen in the last 2 to 3 years, people project anywhere between 15 to 25% rent increases after all these massive renovations. But we know that the market has changed, so we are extremely conservative in terms of what rent projections we are trying to accomplish. So that 12% basically gets us to today's market rents, what we are already achieving, really without baking any other upside from renovations. So If you're able to achieve more upside, then obviously the NOI is going to look even better and the returns are going to look better. So that's kind of the idea here. I think with that, Andy, I'll pass it over to you for the financials.
Sure. Yeah. I think, just to reiterate what you said, Jay, it's nice to see that we're able to achieve those rents present day, right? And as you pull these different levers, in those that aren't as familiar with, some of what we do in our business plan, but as far as renovations, increasing rents, managing the P&L, managing the expense ratio, right? So all the things that we haven't talked about yet that really bolster one thing that is the main goal is that net and that NOI, that net operating income, right? So alongside of what Jay said about having, the tagline, the real cliche thing in today's world of real estate investing is just conservative underwriting. Everyone says conservative underwriting. Truly is conservative. You pair that with an operator that is vertically integrated and as well has skin in the game. They make financial decisions that are for the betterment of the property and not for their own financial gain. You really have a winning, you have a winning mix. So I just wanted to reiterate that. Here's a little bit about an example of a $100,000 investment over the whole period here. I'm not going to go in a lot of detail about this. Just basically, you're seeing the cash flow, the cash on cash returns through 1 to 3, right? So everybody looks at year 3. They say, when am I going to get my capital back? You're looking at the return of capital around 44 to 45% as projected at refi year 3, and then made whole upon disposition or sale. So this will be included in OM that we send you. And if anybody has any granular questions on this, we don't want to take too much time during the webinar because people's different understandings of investing and their different experience levels might bolster more questions than not. So Jay, do you have anything else to say about this?
No, I think that was a good summary, Andy. But I think for first-time investors, this slide can be extremely confusing. So again, we are more than happy to do a follow-up and walk you guys through this slide. Essentially, at a very high level, what each one of these line items mean. This is your original capital. It goes down after a refi because you get portion of your capital back after a refi. And then the other line item that I would like to highlight is member cash flow. And that cash flow is basically coming from rental income, right? So as we collect rents, this is what you're getting back. Finally, I would like to highlight, and this is basically the same number expressed as a percentage. Return of member capital here. Again, it's this one is coming from the refinance, and this is coming from essentially the original capital, balance of the original capital. So 44, and you subtract that from 100K, that's the balance of your original capital getting back to you. And this number here, 65,802, is true profits from exit. So that's how all of these numbers add up. Again, if you would like to dive deeper into how all of these numbers are calculated, we are more than happy to discuss. And also when we send out the slides for this webinar, we will include the detailed underwriting slide. It's just too many numbers on this slide. So we can spend 2 hours just talking about that slide on the webinar, but we will include that for your review after the webinar as well.
Yeah, great. I mean, great explanation, Jay, to reiterate on that. This is probably my favorite slide in the deck for investors. It just gives you a snapshot. Jason does a great job putting this data together for our team and basically gives you what are 4 scenarios in this investment opportunity, right? The conservative scenario, what we expect based on our projections. Hey, if everything goes really good, what's an aggressive, return on capital? And then, hey, we just totally killed it, knocked it out of the park. Here's an ambitious, return on your investment. And I think this kind of reiterates the previous slide, but basically what is the likelihood of this happening? And Jason's put together his assumption of 60% based on our underwriting in that expected, window, which gives you that kind of target IRR that we're looking for, that sweet spot around 15 to 16%. And it's funny because we were talking earlier before the webinar started, and there's a few investors that have told me, hey, if I see anything in a 17, 18, 19 IRR, although I want to see that, I typically run, because not a lot of times is that really potentially achievable, and it's somewhat superficial in some others underwriting. So this is a great slide. Cash on cash, it gives you the expected to 7 to 8%, and as well, the investor equity multiple, which is a key metric here too. So shows you a little bit, based on exit cap rate, in the operating expense ratio. I think even 47%, in my opinion, what Prosper's done with other properties is still a little high. I still think we'll do better than 47%. And investors, those that are new and inexperienced, that's truly controlled by property management, construction management, right? Property management, how can you lower that number from 47% to 40? Well, you implement, ratio utility billing, you bill back water, you put in water conserving appliances like the stealth turrets that we use in every single one of our unit turns. We use aerators on our shower heads to conserve water. We make sure that we're aligning with our vendor partners and our utility partners to get the best costs that we can to really drive that expense ratio down, which then in turn increases the net operating income. So Jay, want to touch on that a little bit?
No, that was great, Andy. Yep. Was anyone saying something? Yeah, I think that was a really good summary, Andy. Again, I think expected versus how are these different, right? And what is our rationale behind it? I think for some of you who have seen other deals, you would very commonly see vacancy penciled in at 5%, right? And we have all noticed, especially in current market cycle, that was way too aggressive. So that's why we actually bumped up our vacancy assumptions to about 10%, and we made that as our expected scenario, right? So that's one metric. Exit cap rate, even right now, we are in the sixes. We are assuming the market is actually going to worsen, meaning the cap rate is going to increase at exit, right? So that's another metric that will drive what exit price we get, and we are being conservative there as well. Andy already spoke about 47%. So to give you guys an idea, we are operating other properties at around 42 to 43%. So we have baked in a little bit of a buffer in there as well. And of course, with older properties, it's always a good idea to have that buffer, because at least for the first year and a half, you really don't know what your repair and maintenance costs are going to be like. So that's why we have baked in that buffer, and we are assuming a higher than normal expense ratio. And again, the 42 to 43% expense ratio that we are operating some of the other properties in our portfolio, they are equally as old as well. They're also 60s, 70s product that we are operating at about 42 to 43% expense ratio. So overall, every single number in this, actually, we have tried to be as conservative as possible. And even the rent comps, we already spoke about that. These are basically the rents that we are already getting for our renovated units. And we are actually projecting that as our pro forma rent after the units are renovated about 6 months to a year from now. So in that sense, we feel very comfortable that these are very conservative assumptions, and which is why we feel that there is a very high likelihood that we should be able to actually hit these numbers based on these conservative assumptions. So, yeah.
Very well put.
Cool. Yes, so these are the financing terms. These are not set in stone, of course, right? So until we are closer to the closing deadline, these terms can change. But these terms are based on a lender that we have worked with multiple times, and also the broker that we have worked with multiple times. So we already know we have a verbal commitment. These are the terms that we are getting. The only thing that we can potentially expect is actually for that rate to actually go down, because the rates have gone down over the last 3 months consistently. But we are assuming still a pretty high interest rate of 7.5%. It is a 10-year term. This is actually the bank and the product that we have used on some of our most recent acquisitions. 24 months is the interest-only period. That gives us enough time to stabilize the property before the loan starts amortizing and the principal payments start. It is a 30-year amortization, which is another great thing. A lot of the local banks typically give you about 20, 25 years of amortization. The other great thing about these debt terms is just a 1% prepay penalty. In current market, actually, most lenders have upped their prepayment penalty, and they're locking people into long-term prepayment penalties with 5, 4, 3, 2, 1 model. So you're kind of stuck and you can't refi without paying a pretty heavy prepayment penalty fee. With this lender, it's a 1% prepay fee, and they waive that if you refi with that same lender. So you have a lot of flexibility in terms of refinancing as well. Loan balance, currently we are expecting about 2.24 million at 80% loan to value, and about 80% of construction cost also given by the lender, effectively meaning 80% loan to cost. So total cost for the project, 80% will be funded by the lender. This lender actually has given us 85 in the past, but for purposes of our underwriting, we are projecting 80%. If we get more leverage, the returns will look slightly better, and that's always positive. So that's more of a icing on the cake, if you will. Going in DSCR is 1.15. So, of course, going in DSCR is not great, but that's the definition of a value add deal. That's where the opportunity is to improve our DSCR. And this lender is a pro forma lender. So they're not looking at our going in DSCR. They're looking at our business plan, our track record, and what we can do with this property and our pro forma NOI to give us that 85% leverage. So in terms of refinance, our projections are refinance end of year 3. As we already talked about, even without the refi, the deal pencils out. But with the refi, the deal looks sweeter. But the refi terms, again, we are projecting an interest rate of 6%. And to be honest, agency refi terms, agency lending terms, even now, I'm seeing high fives, 5.8 to 5.9, very easily achievable. So 6% end of year 3 is very realistic. Obviously, none of us have a crystal ball. We don't know if Feds actually bring down rates now and bring them back again in 2 to 3 years. You never know, but that's why we actually underwrite this both ways, with and without the refi. Term would be TBD. We could either do a 5, 7, or 10-year hold, depending on what best suits the business model at that point and how much of the hold period is left. IO period, again, on a stabilized property, we don't think we need IO period, but there are options to get 12 months of IO on even a 5-year term with agency debt. Amortization on stabilized agency debt is always 30 years. LTV with agency stabilized debt is typically lower, about 70 to 75%. So that's kind of our assumption. So for a stabilized property, we have seen agency do 75 to 77%.
And Jay, I'd just like to add maybe a couple points here for those investors that might be newer, right? They hear these terms, but maybe they're not familiar with the lending environment, and they always hear from the news that interest rates are high. There's a couple safeguards in this chart here that Jay mentioned. The one that's really important is the prepayment penalty, right? Interest rates high now, interest rate lowers. The safeguard is you only pay 1% prepayment in order to get that better rate, right? Upon refi or upon sale. Let's say there was a disposition early because we implemented our business plan and we did it in 3 years and we could sell the property for more than our projected amount, right? That's the safeguard that's in here. The other is, Jay mentioned, we don't know what the future holds, but what we're seeing and what's been signaled is that we will see some, rate cuts on interest, and we're already seeing it now. So just for the investors that are newer, just so you understand this page a little bit better, there are some safeguards, in these debt terms that are advantageous to the deal, which is advantageous to the investor.
Absolutely. Yep. Great point, Andy. Next, we have capital sources and uses of capital. So this is basically how the capital is going to be allocated. Loan amount we talked about, which is currently factored in at 80% LTV or 80% leverage. Our construction line of credit, from the lender, about 80% of our total CapEx budget, which is 600K. So 480. Equity contribution, which is our basically total raise from investors, is going to be roughly around $800,000. So that is a total of sources of capital. Now, how that capital is going to be used, our purchase price for the property is $2.8 million with actually 100K seller credit. So effectively, it's 2.7, which brings the price per door or price per unit at about 67.5. Now, 67.5 is a really lucrative price to pay for primarily 2 bedrooms in these locations. I mean, just about a year ago, this portfolio would have easily sold for 90 a door. 65 to 67 was something that was being paid in Class D neighborhoods, high crime neighborhoods. So it's extremely good price to pay. And also, if we compare it against replacement cost today in these areas is roughly about 225 to 250 a door. So you're buying the property at a significant discount below replacement value. Our CapEx allocation is around $600,000, which is a combination of interior and exterior CapEx. And we will look at the breakdown of CapEx and how that is being allocated in one of our upcoming slides. Operating reserves is about 96,000. So that actually includes, it's more than 6 months of PT reserves, PT meaning principal, interest, taxes, and insurance. So we want to make sure that we have really healthy reserves. So if we have any surprises, we are covered in that sense. Because when you buy a value add deal, you're taking the first year just to get to know the property. You can always come across some surprises, and we want to make sure that we are really well prepared for those surprises. Estimated closing costs are at 86,605. Typically, in our experience, the closing cost is lower than that number. Again, we are just trying to put in a little bit of a buffer on that as well. Our acquisition fee is 2% at $56,000. And then this was the seller credit that I already spoke about. So all in all, that total again is 3.5 million, basically, which exactly ties to that number here. Andy, anything else that you would like to add?
Just that is a smoking price per door. I think there was properties up in Dayton trading at that price, and the fact that you're getting in a location like Cincinnati, where it's located, is just it's part of the story, right? And the investors that are on this call, how did we achieve that, right? We achieved that because of our relationship directly with the seller. We're buying it directly from the person that owns it. We don't have a broker that's the in between, and also through due diligence, working, DJ and Jay and Jason and I, the seller credit too, right? Going through due diligence, leveraging, our knowledge of property condition, and that just adds to a better cost per door. So, no, it's a great slide.
Awesome. So on this slide, we show actually how that those CapEx dollars are going to be allocated. So the 600K in CapEx actually includes roughly about a $60,000 contingency. So if something takes more than what we think, we can dip into that contingency. If we come across an expense that we didn't anticipate, we dip into that contingency and so forth and so forth. So essentially in interiors, we have 257K allocated, which roughly comes out to about 6,500 per door. And that's because it's a blend of mid-grade, premium, and basic turns for an average of 6,500 per door. So if we do a premium turn, we end up spending anywhere between $13,000 to $15,000. If we do a mid-grade turn, it's typically around $7,000 to $8,000. And if we do a basic turn, we are actually under around $3,000. So we just average that out for about $257,000 in interior CapEx. We have $10,000 set aside for water heaters, although the water heaters in both of the properties are basically brand new, about 2 to 3 years old. But we have just set aside that number that when they go out, we actually have money allocated for that. Wall-in AC units, again, these are all in great condition. And these are typically very cheap to replace, about $500 to $550 a piece. So we are allocating $30,000. So we can actually replace quite a few of them if they do go bad, but they were all tested to be in working condition. So just to be extra safe on that as well, on the HVAC expenses. And then we have a reserve set aside for deferred maintenance as well. So that total is around $312,000. On the exterior, that's where we need to put in a lot of work. The asset does definitely look very tired. So fencing, exterior paint jobs, staining the brick, parking lot upgrades and seal coating. Deferred maintenance at McGregor, we just have a $10,000 bucket set aside for that as well to address any other deferred maintenance issues. The roof condition at the Washington building was mediocre. It's not leaking, but we saw some puddles of water. So at some point, we will at least have to coat it with some sort of a coating. So we have actually factored in a full replacement cost in our budget. So if we have to ever replace it, that is factored in here. Exterior paint on Washington. Common areas in McGregor are in terrific shape, so we are not going to paint those. But common areas in Washington property, they need a lot of TLC, so we have factored in that. Plumbing, there was a minor plumbing issue, which is not really underneath the property, but outside of the property that we uncovered during due diligence, which is kind of one of the reasons why we got that $100,000 seller credit. But actually, the cost to repair, we have set aside $25,000, but we have gotten bids to make that repair for as low as $8,000 to $10,000. So again, we are trying to set aside a higher dollar number than what we really need, just to be extra safe. And then deferred maintenance overall bucket for Washington property at $15,000. Rebranding will be new signage for both the properties, a new website, and just overall rebranding and marketing efforts for both properties. We've set aside $10,000 for that effort, and then around $20,000 for landscaping. So that includes cleaning up of all the surroundings, planting some decorative bushes, and just sprucing up the exteriors and curb appeal. So that's how all of the CapEx is broken down. So the total of these two numbers plus another $60K in contingency for a total of around $600,000. Actually, and then before I move to the next slide, we have also put down our insurance, property taxes assumptions. Insurance, we are factoring in at $20,000 for these 40 units, which puts it at around $500 a door. And currently we are paying insurance around $360, $380 per door. So again, we have factored in a little extra buffer in insurance as well. Insurance prices, we all know, have gone up in the last couple of years, but lately they have actually began to come back down. But we still have a decent enough buffer for our insurance pricing as well. Thankfully, we here in the Midwest haven't gotten hit that hard in terms of insurance premiums increase. So that should be a really safe number to play with. Property taxes, we are assuming about 20% increase from 2023 assessment. But in Ohio, what we usually do is something called as a drop and swap or an entity transfer transaction. In just high level layman's terms, what it means that we actually have the owner create a new LLC, drop the property in that new LLC, and we actually buy that new LLC. So it's not a real estate transaction, but it is a business transaction where we buy the LLC. So you don't have to report the sales price to the county. Effectively, you don't get hit with higher taxes. So if that happens successfully, essentially there would be no tax increase, but we have still factored in 20% tax increase, again, just to be safe. Rent growth assumption is factored in at 3%, which I think most of you will agree is a very conservative rent growth assumption. And again, there could be some years where we could see 1 or 2% rent growth, but there could be some years where we could see double-digit rent growth. And at least for the last 4 years, we've always seen double-digit rent growth. But of course, the market has changed, so we are being extra cautious and allocating only about 3% towards rent growth assumption. And inflation, about 3% at all. So essentially, our rent growth and inflation is evening itself out, and the numbers still pencil out. So that's essentially the summary of CapEx allocations. I'm just trying to see how we are doing on time. So we'll try to move through some of these slides relatively quickly. In terms of location, we made some commentary about location already. We'll be sharing these slides also. So this just shows you a high level of Cincinnati MSA. The MSA is actually a lot bigger than a lot of people think. It's over 3 million in population. And this map just shows some of the hotter areas and good neighborhoods to invest in. So we are actually very close to the heart of Cincinnati in this spot here with this property. These are some of the major employers. We are home to 8 Fortune 500 companies here in Cincinnati. The good thing about all of these employers is the diversity in industries, right? So we are not overly dependent on just financial sector or oil and gas. There's a mix of multiple industries. We have a big hub for healthcare, about 5 large financial corporations, a lot of consumer products like Kroger, Procter and Gamble, Cintas, Cincinnati Bengals put us on the map last year. I know this year we didn't do that well, but Reds, Cincinnati Reds, the baseball team, and the Bengals also attracts a lot of people to this area. Steel, AK Steel is a large steel manufacturer, also located just north of Cincinnati, and GE Aviation, where all the Boeing engines are manufactured here in Cincinnati, actually. So really good diversification. Again, especially with recession fears around the corner, it's always good not to be over-reliant on one specific industry sector. Again, some more information about location and some of the key spots nearby. So this is the McGregor property, and this is the Washington Court property. So they're both fairly close to each other. The Great American Ballpark is right here, which is the baseball stadium where Cincinnati Reds play. The other key highlights would be University of Cincinnati, which is 13. So you see, this is the asset, and this is University of Cincinnati. And then Xavier University is 14. So this is the asset, and Xavier is right here, roughly about a mile away. And the University of Cincinnati is actually less than a mile away, so roughly about half a mile. So having close proximity to college campuses, to shopping malls, to downtown and the highways, you can see 74, 75, 275 runs through horizontally here. So a lot of highways flowing through these areas as well. All of these benefit us because people working in downtown areas, they want to get on the highway to go to work. People going to school, again, close proximity. Major hospitals, Mercy Health System Hospital, the Jewish Hospital, many hospitals in these areas as well. So we look at all of these things. How close are we to retail and shopping, restaurants, schools, hospitals, and highways to get to downtown? So this provides an overview that we are really close to all of these key locations here. Andy, anything else you would like to add about the location or?
No, I think you highlighted a lot of it is just, you look at where these properties are positioned, and, you look at demand. And when you talk about just investing in general, you invest in an asset where there's demand, and there'll continuously be demand in this area, and us injecting capital into these properties and doing our renovations, interior and exterior, it's just going to continue to increase the demand. So that's not a hard concept for, I think, anybody to grasp, even if you're a new investor or you're a very experienced investor. So you buy assets, good locations, good upside, and I think these are two assets that we can achieve some nice returns on.
Awesome. Yeah, I think a little bit about the team. Andy, if you want to go ahead.
Yeah, DJ, he's on this call. He's Prosper is his baby. He's worked real hard and fostering a great community with Prosper Communities, and really driving the business plan with property management, right? You're buying these assets, and managing them is key, and managing them right. That gives you greater control of the asset over the whole period. So his team's done a great job. I'd encourage anybody on this call. I know there's a lot of people on this call that aren't from Cincinnati. If you're curious, go Google Linwood Towers. We've got consistent 5-star reviews for the last couple years after we took possession of that property after acquisition and really turned it around. And I think seeing any property manager with over a 3-star is a rarity, and seeing 5 is very difficult to achieve. So kudos to his team for doing that. Alongside, Prosper Construction, DJ and I, we've taken on some pretty heavy lift projects over the years, including a complete redevelopment not too far from Kenwood Mall. So, just to reiterate to those that haven't invested with us before is we have the experience. We've done heavy lift projects. Jay has as well. And I think that this is a great team. Somebody put in a question in the notes. I think that's easy to address right now is what is the relationship between compounding capital and Prosper Capital? And, Jay, I'll let you highlight a little bit about that, but Prosper Capital has a presence of a vertically integrated model here. And that was, I think, a piece Jay was missing from his organization, which is compounding, right? And Jay, I won't speak for you, but the ideology is, DJ and I are buying properties in town. Jay's buying properties in town. We're vertically integrated. We've got a model that works for him, and it makes sense for him to fold into our model under really one umbrella, which I think is the ultimate goal. Jay, and I'll let you speak to that. So,
yeah, no, absolutely. Thank you, Andy. So, yeah, I mean, essentially, I've known Andy and DJ for 4+ years now, and we saw each other doing basically the same stuff. We were going after the same assets. We were putting offers on the same assets, meeting the same brokers, talking to the same lenders, and we were building our own portfolios kind of individually. What we realized was, okay, we had built a decent sized portfolio. DJ and Andy had built a decent sized portfolio. I was trying to do a little bit of construction management and heavy lift deals myself. And DJ had actually spent a good amount of time in building really solid processes around property management and also construction management. And what we realized is, when the market is going up and up during like COVID times and double-digit rent growth, you can have some inefficiencies and you can still make money. And when you use third-party management, you are bound to have some inefficiencies. So which is why we had that conversation that, hey, why not we start working together? For us at CCG, it made a ton of sense to partner up with Prosper with in-house property management as well. That way, any inefficiency there is, we are able to get rid of it. And especially in a tightening market cycle, you have to make sure that you're truly focused on that NOI. You're truly keeping your expenses low because there is no wiggle room now, right? And also, in addition, there's a lot more players in the multifamily market who are bidding up the prices. So how can you offer competitive prices and still make money? The answer to that is super efficient operations. And with DJ building Prosper communities, you can look up the reviews as Andy was talking about. Usually everybody just, pardon my French, but bitches about property management because everybody goes to Google to complain about how their property management company sucks and how their toilet is not getting fixed and stuff like that. So it is really difficult to get good Google reviews for PM. And by the end of the day, we are in customer service business. Our true clients and customers are our tenants. If they are happy, the properties continue to perform and the NOI continues to look solid. So with that kind of rationale, we teamed up together. We started working together, and basically we are working in the background to basically merge all of our assets, branding, and stuff like that. So essentially now we are one company. So hopefully that answers that question in the chat box here. Cool. I think we can move on to the next slide. We spoke a little bit about the team. I think, Andy, we can probably just keep this slide high level.
Yeah.
Yep.
Just for, time's sake, because we're running on an hour now, we want to leave some time for questions. Just, what does our combined portfolios look like? The first question you should ask if you invest with anybody is, can I trust this person? And can I trust these operators? If I wire my $100,000, are they going to do what they say they're going to do? Right. And you should ask yourself, well, have they done it before? Show me the assets that they've done it on, and ask people if they've ever interacted with them before, invested with them before. So we're more than happy to give investor references. As we've already talked about, there's over 7 years of combined property management experience. I have my own portfolio of properties. DJ and I have, worked together since 2020, I believe, bringing Jay into the fold now. So the team's experience is there. We've brought Jason in and Anthony in, obviously to the team to assist, and they have specific things that they really bring and value that they bring to the team. So I'm very excited about this team that we've built over the years. And I think, you know, as an investor, you go back to square one. Can I bet on that jockey to deliver, right? Is that jockey going to deliver for me? And I think that we've got a really strong team here. Average ROI since inception is 20. That's a strong number. And IRR is 19. And that's a hard number to beat, especially in, you know, a marketplace now where Jay mentioned, is you've seen some superficial returns on people that bought properties at a good price, and really the appreciation of that property gave them a win. Well, who's going to win in these next 3 to 5 years? It's the operators. The operators are going to win. Those that control the assets the best are going to control the returns for their investors. And I know if I was an investor, I sure as heck would want to make sure that I invested with somebody that was controlling that asset and that was vertically integrated.
Absolutely. Right.
Very important slide here, timeline. And we'll try to finish it out with this is, you know, you as an investor, you know, what are next steps for you if you're interested in investing with us, which we love to earn, you know, your trust in doing so. Right now, we are accepting soft commits. You know, I will disclose that we're already 50% subscribed on this deal. And, you know, we're just now getting this webinar out. We've had so much interest from, you know, our investor community already. So if you do have interest, step one for you would be to sign a soft commit. You contact me directly and I'll send you over a DocuSign for that soft commit. That gives you really a place in line. And that's really, really important now that will probably be funded in just the next couple days based off of investor interest. And then the 23rd of the month is really when we're looking to have funds start to be wired. We're looking for a projected closing date around September 25th. So important dates for all you investors to understand is today's the 8th. We want all soft commits in by the 16th, which is about, you know, 1 week. The funds wired on the 23rd. And as we move into the closing estimated date of the 25th, around the 9th, the private placement memorandums will be sent out for you to review and to ask questions on to sign. So, Jay, anything to add?
No, I think that was a good summary, Andy. I think we can move to the next slide, which is our last slide. So,
yeah, I mean, we're only raising 800,000 for this. That's the open call. Already halfway there. 100,000 is our investment minimum. And really, this graphic shows what I think is really what we stand for, and it's vertical integration. You know, Prosper Capital finds these deals, we fund them, we asset manage them. We have in-house property management. We flaunt that a lot because to me, it's really what's you know, going to bring you to a successful disposition on a property. But how do we do that? We implement our construction teams, right?
Hi, babe.
So that's really what we do.
Hi. Took you so long to...
Well, Ian's talking. I think he's talking to his dog, maybe. I heard that, Ian. But I think maybe we open it up now, Jay, to questions that anybody has. That way we can kind of wrap this up and not take up too much of people's evening. So
yeah, absolutely. And I've basically allowed everybody to unmute and ask questions directly, or folks can drop them in the Q&A box, whichever works. If there's any questions.
there's no way we did that good of a job. Somebody's got to have some questions. Nobody? Anthony, you probably got a question for us.
Yeah, I'll go ahead and touch on just one thing. I know supply and demand is a big driver for real estate, and especially market rent and other. There's conservative underwriting on the rent, and so what does supply and demand look like in Cincinnati?
Jake, you want to take that?
Yeah, no, that's a great question. Actually, you will read many articles about oversupply in multifamily, but if you look at the numbers closely, most of that oversupply is happening in markets like Sunbelt markets, essentially. So Texas, Arizona, Carolinas, Florida, and to some extent in Tennessee. We are not seeing a lot of oversupply in this market. There's definitely a lot of new construction, but that supply is going to dwindle really soon because new construction starts are at an all-time low because of the current interest rate environment. So by 2025, all this new supply that is hitting the market is going to be absorbed and will be again in a really high demand environment. But in this market, we are still seeing tremendous housing shortage. And the reason for that and why we are not in an oversupply situation is because technically, I mean, throughout the US, the cost to build is more or less the same. It's going to be around 200,000 if you're a really good construction company and keeping everything in-house. The more subs and contractors you use, you're looking at more like $250,000 to build one apartment. Now in Cincinnati, if it's costing you $250,000 to build, you got to rent it at least at $2,500 to $3,000. But we just don't have those kind of rents in this market. Maybe in some pockets we do, but not in general. You know, this market usually targets around $1,200 to $1,400 in average rents, which is why it just doesn't make sense to build brand new Class A stuff here. And you see a lot of that happening in some of these coastal markets where people can charge $2,500 for a one-bedroom apartment. So we are not too worried about oversupply situation in this market. Another reason why every report is showing multiple cities in Ohio and Midwest in general, including Kansas City, Indianapolis, Columbus, Cincinnati, always in the top 10 list in the last multiple months that you see in terms of rent growth. So.
Yeah, and Jason just put in the chat too. I mean, 5.6% of existing inventory, you know, under construction, which is, you know, minimal with 5,800 units.
Yeah.
So just goes to show the opportunity. Who else we got? Anybody else have any questions? If not, you know, we can wrap it up. I know it's already 9:05 Eastern, but anybody else? No, we just did that great of a job, Jay.
I guess so. Or we also appreciate follow-up questions. So
Yes.
which is why we have the Calendly link over here. So if you want to set up a one-on-one call to discuss any follow-up questions or want to dive deeper into any of these slides or the underwriting, just let us know and we are happy to do those calls as well. And
yeah, and I'll just add too for the investors that are local. You know, we'd love to have you, you know, and show you some of the properties in our portfolio. We have several hundred units here in Cincinnati. We've got, you know, a couple properties with an easy driving distance where we have renovations going on right now. So if it's something you want to see what the team's actually achieving, I do it all the time. I take investors to our current projects all the time. I'd be more than happy to do so, you know, to catch up on coffee and show you some of the projects that we have going on. So great. Well, hey, appreciate everybody's time this evening. And look forward to earning your trust and the opportunity to partner with you on this deal. And as Jay mentioned, reach out to us directly. Soft commits due in a week. And I think this one will fill up pretty quickly. So halfway there already. So appreciate your time and look forward to hearing from you.
Great. Thank you so much, y'all.
All right,
Have a great
take
day.
care.